The final style of trading that we will be discussing within this subsection is the contrarian approach. This involves regular trading methods, generally in short to medium term timeframes, except trades are taken in opposition of typical market trends. In other words, the contrarian trader will buy when others are selling and sell when others are buying. The belief system of a contrarian typically involves the ideology that market participants can become overly optimistic or overly pessimistic, so much so that price fluctuations are simply overextensions of the market equilibrium. This is generally defined as mean reversion, a financial theory that suggests that price will return to its equilibrium or average. Under this belief system, the contrarian style of trading can provide huge opportunities when consumer sentiment ultimately reverses. Consumer sentiment can be defined as the general anticipation of market movement and pricing from the participants involved within the market. So, if price is moving up, consumer sentiment is likely to be bullish and would likely be bearish if price was moving down. The contrarian trades against consumer sentiment, or at least against the general direction or trend of price. While this might sound rather foolish, it can offer a lot of potential. A reversal in consumer sentiment and a reversal in price will typically result in a high level of liquidation. This can otherwise be defined as a disproportionate amount of buying or selling. From this imbalance in buying and selling, price may form very aggressive and unnatural movements, which can be formed partially out of fear, greed, euphoria, or FOMO from the participants. This is all to be capitalized on by the contrarian who had entered their position before the reversal had actually taken place. Since they had entered early, this means that they have a lot of room to exit their position for favorable returns. You can imagine the profitability of this in regards to options contracts. This also reduces the risk on any given trade quite drastically. This, of course, is with the assumption that price action is in the contrarian's favor. You can imagine that the contrarian is basically trying to get the best possible entry for reversal at all times. They want to be the first ones in, as it maximizes profit potential and minimizes risk potential. An example of when a contrarian may enter a position is if there is variance between price action and consumer sentiment. So say that the market has been going up, but a very important press conference was released with economists who believe prices should be going lower due to increases in inflation or whatever it may be. While prices are going up, economists believe price should go down, meaning there is a negative correlation between price action and consumer sentiment. This could imply that price will ultimately move to the downside, a thought which may have our contrarian trader enter a position against the uptrend. So the contrarian believes that price cannot go up forever, and in all reality, that is true. Price always retraces, at some point or another. It is more so about knowing when these retracements occur. The contrarian does not really care about when, they just know that it will happen, and they will be the first ones in. Now, of course, I am taking a more extremist approach. There is huge variance in regards to how contrarian traders do identify levels. But with that said, typically the contrarian will be getting in before everyone else. The problem with this, and a major disadvantage with the methodology in general, is the significant challenge in timing entries properly, as I just mentioned. Since the contrarian will not typically wait for a valid confirmation of a reversal, they will often be entering positions based on smaller factors which influence price or have little impact on price action in general. This significantly reduces the likelihood or probability that there will be a reversal, but also increases the profitability of that trade. One example of this could be 3 down closing candles in a row. While this may tell us that price is beginning to trend downwards, it is not explicitly displaying a proper reversal, as it could be simple retracement which may be followed by trend continuation. The contrarian is working off of the assumption of what will happen as opposed to acting on what has happened in actuality. And this is the thing with this approach. At its core, the contrarian is going directly against the trend that is simply what this strategy is. Consumer sentiment, otherwise defined as the attitudes, values, and behaviors of market participants, is going to follow the trend of the market. The contrarian is in the minority in regards to direction, so all odds are essentially against them. This is half due to the fact that market participants believe there is trend momentum and that market participants actively participate in the strengthening of that trend. This is better known as the self-fulfilling prophecy, which says that your beliefs about something will drive the actions that are necessary to make that belief become true. In other words, you are fulfilling your own belief by believing it. This can make it very difficult for the contrarian trader to find opportunity within the market, as the market is trending most of the time and is only reversing a fraction of the time. This can also lead to significant limitations on short-term profit, as trends can last as long as many years or even decades.